Somewhere in Tokyo right now, a fund manager is staring at a number that keeps getting worse every single quarter, and that number just quietly rewired the way the entire planet thinks about who is really funding America's debt. Japan's four biggest life insurers, Nippon Life, Dai-ichi, Sumitomo Life, and Meiji Yasuda, just reported combined unrealized losses of 15.13 trillion yen on their domestic bond portfolios, which works out to roughly $96 billion. And that figure is not shrinking, it is climbing, up about 7% in a single quarter, and it has been climbing for 2 straight years, from around $67 billion in mid-2025 to $86 billion by the end of that year to $96 billion just a few weeks ago. If you only look at the headline, it sounds like Japan is broke. It is not. But the real story hiding underneath that scary number is far bigger than a handful of insurance companies losing paper value, because it touches the yen. It touches the world's biggest bond market. It touches your mortgage rate, and it touches whether the country that has quietly bankrolled America's deficit for 3 decades is finally walking away from the table. So let's actually understand what's happening, because almost nobody explaining this online is connecting all the dots correctly. Picture an insurance executive in Tokyo named Daisuke. For his entire career, buying Japanese government bonds was the safest, most boring decision imaginable. Interest rates in Japan sat near zero, sometimes below zero, for the better part of 3 decades. Insurers like his loaded up on ultra-low yielding government debt because it matched the long-dated promises they'd made to policyholders decades into the future. Nobody thought twice about it. Then something that hadn't happened in a generation started happening. The Bank of Japan, after sitting on negative interest rates and yield curve control for years, began actually raising rates and letting long-term yields float freely. And when interest rates rise, the market value of every bond issued before that rise instantly drops, because nobody wants to hold an old bond paying 1% when new bonds are suddenly paying 2.5% or 3%. Daisuke's older bonds, the ones bought back when yields were near zero, are now worth dramatically less on paper than what his company paid for them. Multiply that across 4 of the largest insurers in the country, and you get a combined whole of $96 billion. Here's the part almost every panic headline skips. This is an unrealized loss, meaning it exists only on paper at this exact moment, based on what the bonds would be worth if sold today. Life insurers generally don't sell. They hold these bonds to maturity to match liabilities that stretch decades into the future, collecting the full face value at the end, regardless of what happens to the price in between. So on the surface, this looks like an accounting headache rather than a company about to collapse. But there is a real danger scenario, and Japan's Financial Services Agency is watching it closely enough that they've accelerated reviews of insurer balance sheets. The danger is liquidity, not solvency. If enough policyholders decide to cash out their policies early, all at once, in a wave, insurers would be forced to raise cash fast. And the only way to do that quickly is to sell bonds at today's depressed prices, turning what used to be a paper loss into a real, permanent, realized loss. That is the scenario regulators lose sleep over, a rush for the exits that forces institutions to crystallize losses they were never supposed to have to take. Now here's why this stopped being a purely domestic Japanese story and became something traders in New York and London are obsessively tracking. To understand it, you need to understand the number underneath the number, the actual yield on Japan's benchmark 10-year government bond. For most of the past 30 years, that yield sat near zero, sometimes literally negative, meaning investors were paying the Japanese government for the privilege of lending it money. In the middle of 2026, that same 10-year yield touched levels not seen since 1996, crossing 2.9% at one point, a level nobody trading bonds today has ever actually lived through professionally. Some readings put it at the highest print since 1999, a 27-year high. 5-year Japanese bonds hit record levels above 1.8%. 20-year bonds pushed past 3.9%. This is not a small technical move. This is the complete unwinding of the defining feature of Japan's financial system for a full generation, the assumption that yields stay near zero forever. Several forces are colliding to cause this. The Bank of Japan, led by Governor Kazuo Ueda, has been gradually normalizing policy, hiking the benchmark rate to 0.75%, the highest level in roughly 30 years, and signaling more hikes are possible if inflation data cooperates. At the same time, Japan's new Prime Minister, Sanae Takaichi, won a landslide election on a platform of expanded government spending and stimulus, including suspending the sales tax on food. And bond markets do not love it when a government promises to spend more while yields are already rising, because more spending usually means more bond issuance, and more supply pushes yields even higher. Layer on top of that an oil shock tied to conflict in the Middle East, which pushed up energy costs in a country that imports almost all its oil, adding inflationary pressure that gives the Bank of Japan even more justification to keep hiking. Three forces, monetary tightening, fiscal expansion, and an energy shock, are all pushing the same direction at the same time, and that is why yields are moving as fast as they are. Now picture Daisuke again, except now imagine he's not just managing an insurer's back book, he's deciding where new money goes. For years, the math was simple. Japanese bonds paid almost nothing, so any investor who wanted a real return had to go overseas, buying US Treasuries, European debt, corporate bonds, anything offering a real yield. That overseas hunger from Japanese capital helped keep global borrowing costs lower than they otherwise would have been, especially in the United States, because Japan has been either the largest or second largest foreign holder of US government debt for years, competing back and forth with China for that title, currently sitting around $1.1 to $1.2 trillion in Treasury holdings. But now Daisuke can earn 2.5%, almost 3% just by buying his own country's government bonds in his own currency with zero exchange rate risk. Compare that to a US Treasury paying a higher headline yield, but exposed to swings in the dollar-yen exchange rate that can wipe out the yield advantage in a matter of weeks if the yen strengthens. Suddenly, the calculation that justified decades of Japanese money flowing overseas starts to look a lot less obvious. This is the essence of what analysts are calling capital repatriation, the theory that Japanese institutional money, which has been flowing out of the country for 20 years, could start flowing back home. And the early evidence suggests it's already beginning. In the first quarter of 2026 alone, Japanese investors sold roughly $29.6 billion of U.S. debt, removing a buyer that global bond markets, already dealing with enormous fiscal deficits, had relied on for years. This connects directly to a second related phenomenon that's been making headlines for 2 years running, the yen carry trade. For those unfamiliar, the carry trade works like this. An investor borrows money cheaply in a low interest rate currency, historically the yen, and uses those borrowed funds to buy higher yielding assets somewhere else in the world, pocketing the spread between what they pay to borrow and what they earn on the investment. This strategy exploded in size over the past decade specifically because Japanese rates were pinned near zero, while the rest of the world, especially the United States, offered meaningfully higher returns. Estimates have put the scale of outstanding yen-funded carry positions in the hundreds of billions of dollars, some analysts even suggesting figures north of $500 billion, when you include leveraged positions across equities, emerging markets, and crypto. The problem with a carry trade built on borrowed money is that it only works as long as the interest rate gap stays wide and the funding currency stays weak. The moment Japan starts raising rates and the yen starts strengthening, the trade begins working in reverse. Borrowing costs rise, the currency you owe money in gets more expensive to buy back, and the entire strategy that looked brilliant a year earlier starts bleeding money fast. We already got a preview of what this looks like in practice. Back in August of 2024, a surprise Bank of Japan rate hike triggered a sudden violent unwind of carry positions that helped crash Bitcoin from around $64,000 to $49,000 in less than 48 hours, alongside sharp sell-offs in global equities. That single event became the textbook example every trading desk now references whenever Japan even hints at tightening policy. Since then, markets have been trading in a nervous rhythm, relaxing every time the Bank of Japan sounds dovish and delays a hike, and tensing up every time it signals the tightening cycle is continuing. Earlier this year, when Wada cooled expectations for an April rate hike, risk assets, including Bitcoin, rallied because traders read it as an extension of cheap yen funding. But the broader direction hasn't changed. Japan's rate differential with the rest of the world, particularly the United States, has been narrowing, and every basis point of narrowing makes the carry trade less profitable and more likely to unwind further. Analysts studying this in 2026 generally agree on one thing, that a full-scale, disorderly unwind hasn't happened yet, but the conditions for one are quietly accumulating in the background. Interest rate differentials shrinking, Japanese yields hitting multi-decade highs, and a government actively encouraging money to come home. Now, let's zoom out to the biggest and most consequential piece of this entire puzzle, Japan's government pension investment fund, known as GPIF, the single largest pension fund on the planet, managing somewhere around $1.8 trillion in total assets. Roughly half of that, close to $930 billion, sits in foreign assets, heavily weighted toward U.S. Treasuries and other overseas government debt. For over a decade, GPF has been a quiet but massive source of demand for American debt, part of a broader wave of Japanese capital that sent more than $200 billion net into foreign bonds over the past 10 years alone, more than it sent into Japanese government debt over that same period. That flow helped absorb some of the enormous supply of treasuries the U.S. government has issued to fund its deficits. Here's what changed. Japan's finance minister, Satsuki Katayama, made comments suggesting the government wants pension funds to consider rebalancing toward domestic assets. And even that relatively offhand remark was enough to spark the biggest single-day rally in Japanese government bonds in almost 2 years, along with a jump in the yen off multi-decade lows against the dollar. That's how sensitive markets have become to even a hint that Japan's pension money might start coming home. To be clear, GPIF has not announced any formal change to its allocation targets, and most analysts studying the fund's history point out that previous shifts in its asset mix have taken years, not weeks, to play out, because pension fund governance moves slowly and deliberately by design, and because GPIF still has a return target it needs to hit, which means it can't abandon higher-yielding foreign assets purely for political reasons. Multiple strategists describe the likely path not as a dramatic fire sale, but as a slow burn, where maturing foreign bonds simply get redirected into domestic paper over time rather than reinvested abroad, a gradual redirection rather than a stampede for the exits. But slow does not mean small. Even a modest 5% shift of Japan's foreign bond allocation back toward domestic assets would represent tens of billions of dollars in reduced demand for instruments like U.S. Treasuries, spread out over time, but still meaningfully changing the buyer landscape. And GPIF is not acting alone. Japan Post Bank, sitting on roughly $1.5 trillion in assets with significant holdings in U.S. mortgage-backed securities and foreign sovereign debt, faces the exact same incentive structure. Rising domestic yields making the currency hedged return on foreign bonds look far less attractive than it used to. When you add life insurers, GPIF, and Japan Post Bank together, you're looking at trillions of dollars in assets, all facing the same directional pull at the same time, even if each individual institution moves cautiously and gradually. So what actually happens if this repatriation trend keeps building? Let's walk through the mechanics, because this is where the story becomes genuinely global. If Japanese institutions collectively reduce their U.S. Treasury holdings, even gradually, that removes a historically reliable source of demand from a market that is already dealing with enormous new bond issuance to cover U.S. budget deficits. Basic supply and demand applies to bond markets just like anything else. Less demand relative to supply generally means bond prices fall and yields rise. Rising Treasury yields matter far beyond Wall Street trading desks, because Treasury yields function as the benchmark interest rate for enormous parts of the American economy. Mortgage rates are priced off the 10-year Treasury yield. Corporate borrowing costs are priced off Treasury yields, auto loans, business expansion financing, even the interest the U.S. government itself pays on its own rapidly growing debt, all of it ultimately traces back to what happens in the Treasury market. If foreign demand from a buyer as large as Japan meaningfully softens, the most direct consequence is that borrowing becomes more expensive across the entire American economy at exactly the moment when the U.S. government is already running historically large deficits and needs to issue enormous amounts of new debt just to keep functioning. But here's the crucial nuance almost every alarmist headline conveniently leaves out. The U.S. Treasury market is the deepest, most liquid bond market in human history, measured in the tens of trillions of dollars. Japan alone cannot simply dump its holdings and single-handedly crash the market, because the sheer size and liquidity of treasuries means the market can absorb very large transactions without collapsing, even if a rapid and disorderly sell-off would create real short-term volatility. Analysts have actually modeled scenarios where a large-scale foreign divestment from treasuries on the order of $140 billion would meaningfully shock yields higher but would not, on its own, trigger a systemic crisis. And there's a natural offsetting force, too. When treasury yields rise, they become more attractive to other buyers who weren't previously interested. Domestic pension funds, insurance companies elsewhere in the world, yield-hungry investors who see an opportunity in higher returns on the safest sovereign debt on the planet. Markets have absorbing mechanisms built into them precisely because deep, liquid markets attract new buyers whenever prices become cheap enough. So the realistic scenario isn't Japan single-handedly crashing America's bond market overnight. It's something slower and more structural, a gradual erosion of one of the most reliable sources of foreign demand the Treasury market has ever had, forcing yields structurally higher over time than they otherwise would have been, adding persistent upward pressure on borrowing costs throughout the American economy, even without any single dramatic selling event. Now, let's flip the lens back to Japan itself, because higher yields aren't purely bad news at home, even though the transition getting there is genuinely painful. For institutions holding old, low-yielding bonds bought during the decades of near-zero rates, the transition means real, uncomfortable losses on paper and potential liquidity stress if policyholders or depositors pull money out faster than expected. But for new money going forward, higher domestic yields mean Japanese savers, pension funds, and insurers can finally earn a real return on safe, yen-denominated government debt again, something that was essentially impossible for most of the past 3 decades. Strategists at major asset managers are increasingly describing Japanese government bonds as shifting from what they used to call uninvestable, meaning yields were too low to bother with, to genuinely investable again. Now that investors are finally getting paid to hold Japanese paper, that's a structural multi-decade shift, not a temporary blip. And it matters because it changes where global capital naturally wants to sit. For decades, the entire developed world operated under an assumption that Japan would always be the place capital flows out of in search of yield elsewhere. If that assumption breaks, even partially, it doesn't just affect treasury auctions. It reshapes currency markets, it reshapes how leveraged trades get funded globally, and it reshapes the calculus for every institutional investor who built strategies assuming cheap, abundant yen liquidity would always be available. There's also a political dimension worth understanding, because Japan's new leadership is not shy about wanting this shift to happen faster. Prime Minister Takeichi's administration has been described by analysts as actively encouraging capital repatriation as part of a broader economic strategy, sometimes described as the missing piece in Japan's long-running battle against deflation, essentially using higher yields and returning capital as tools to reflate the domestic economy after decades of stagnation. When a government wants a trend to accelerate and has direct influence over the asset allocation committees of trillion-dollar pension funds, that trend tends to gain momentum over time, even if it starts slowly. So where does that leave us? Let's connect every piece back together one final time. Japan's insurers are sitting on $96 billion in unrealized bond losses because decades of near-zero interest rates suddenly gave way to the fastest yield spike Japan has experienced in a generation. That yield spike is being driven by a Bank of Japan finally normalizing policy, a new government promising more spending and issuing more debt, and an oil shock adding inflationary fuel to the fire. Those same rising domestic yields are making it more attractive for Japanese money, from life insurers to the world's largest pension fund to Japan's postal banking giant, to keep capital at home rather than sending it overseas the way it has for decades. Some of that shift is already visible in the data, tens of billions of dollars in U.S. debt sold in just the first quarter of this year alone. The same dynamic is squeezing the yen carry trade that has quietly funded leveraged bets across global markets for years, a trade that already demonstrated in dramatic fashion back in August of 2024 exactly how violent an unwind can look when it happens fast. None of this means Japan is about to dump every treasury bond it owns tomorrow morning. The evidence overwhelmingly points toward a gradual, structural rebalancing rather than a sudden fire sale, and the sheer depth of the U.S. Treasury market means it can absorb substantial selling without collapsing outright. But gradual does not mean irrelevant. Even a slow, steady reduction in demand from one of the largest, most reliable foreign buyers in Treasury market history adds persistent upward pressure on yields, and therefore on borrowing costs, across the entire American economy for years to come. For everyday people watching this unfold from the outside, here's what actually matters. If you're American, this story is quietly connected to your mortgage rate, your auto loan, and the interest rate environment your government has to operate in while running enormous deficits. If you're an investor anywhere in the world, this story is connected to currency volatility, to how leveraged trades funded in yen behave during stress, and to whether some of the risk assets that benefited from years of cheap yen liquidity, from crypto to emerging markets to leveraged equity positions, face persistent headwinds as that liquidity source structurally shrinks. And if you're trying to understand global macro trends before they become mainstream headlines, this is exactly the kind of slow-moving structural shift that ends up mattering far more 5 and 10 years down the road than any single day's market panic. The $96 billion number that started this story isn't really about Japan's insurers at all when you trace it all the way through. It's a symptom of something much larger, the end of an era where the entire world could assume Japan would always be the source of the cheapest money on the planet. That era appears to be ending, not with a crash, but with a slow, grinding, multi-year shift in where trillions of dollars of capital decide to live. And that is a story worth watching closely. Because when the largest pension fund in the world, the largest life insurers in a major economy, and one of the biggest postal banking institutions on earth all start facing the exact same incentive at the exact same time, the eventual outcome tends to ripple through every corner of the global financial system, whether people are paying attention to it yet or not. Let's dig even deeper into the numbers, because the scale of Japan's overseas footprint is honestly hard to grasp until you see it laid out. Japan held a record 561.75 trillion yen in total foreign assets in 2025, roughly $3.5 trillion, making it the third largest holder of foreign assets globally, trailing only Germany and China. That is not a rounding error in the world economy. That is one of the largest single pools of overseas capital any country has ever accumulated, built up over decades of a weak yen, near zero domestic rates, and an aging population that needed somewhere productive to park retirement savings. And within that enormous pool sits somewhere around $9.5 trillion in total foreign holdings of U.S. Treasuries across all countries combined, with Japan and the United Kingdom essentially trading places at the very top, depending on the month, both hovering in the range of $1.1 to $1.2 trillion, followed by China, whose holdings have been gradually declining for years, even as its total foreign reserves remain enormous. Together, Japan, the UK, and China account for roughly a third of every dollar of foreign-owned U.S. government debt in existence. That concentration is exactly why any hint of a shift in Japanese behavior gets this much attention from bond traders, because there simply aren't many buyers on Earth large enough to fill the gap if one of the very top three decided to meaningfully pull back. Now let's talk about the currency side of this, because the yen's exchange rate against the dollar has been doing something historic in its own right. The yen weakened to levels against the dollar not seen since 1986, before many of the traders currently working on Wall Street trading desks were even born. At one point, trading past 161 yen to the dollar. A currency that weak makes imports, especially energy imports, dramatically more expensive for Japanese households and businesses, which is part of why inflation has stayed stubbornly above the Bank of Japan's target for an extended stretch, and part of why there's been genuine political pressure on the central bank to keep tightening, even though higher rates cause exactly the kind of bond market pain we've been describing. It's a genuine bind. Keep rates low, and the yen keeps weakening, inflation keeps running hot, and imported energy costs keep squeezing households. Raise rates to defend the currency and fight inflation, and you deepen the unrealized losses sitting on the balance sheets of every major financial institution still holding old, low-yielding bonds. There is no painless path out of this, only a choice about which kind of pain to prioritize. And so far, the Bank of Japan under Governor Ueda has been choosing gradual normalization over currency defense, hiking carefully rather than aggressively, which is exactly why yields have been grinding higher in a series of steps rather than spiking all at once. It's worth pausing on just how unusual this entire situation is from a historical perspective. For the better part of 3 decades, since the collapse of Japan's asset price bubble in the early 1990s, the country has been synonymous with deflation, stagnant growth, and interest rates pinned at or below zero. An entire generation of global investors built strategies, careers, and market assumptions around the idea that Japan would permanently be the world's cheapest source of funding. Central banks elsewhere used to study Japan as a cautionary tale, the so-called lost decades, a warning about what happens when deflation gets entrenched. Now, for the first time in a generation, that entire framework is being rewritten in real time. Inflation has returned to Japan and stayed there. Wages have started rising meaningfully for the first time in decades, with the Bank of Japan itself projecting steady wage growth continuing into 2026 as corporate profits improve. Bond yields that were essentially a rounding error for years are now the highest they've been since the mid to late 1990s. This is not a minor market fluctuation. This is the unwinding of a multi-decade macroeconomic regime. And regime changes of this size do not resolve themselves in a single news cycle. They play out over years, sometimes over the better part of a decade, with plenty of twists, reversals, and false alarms along the way. That's actually a useful lens for thinking about the carry trade unwind risk specifically. We've already seen how sharply things can move when expectations shift quickly, the August 2024 episode, where a single surprise rate decision triggered a violent, correlated sell-off across crypto and other leveraged risk assets within 48 hours. But we've also seen the opposite pattern repeatedly since then, moments where the Bank of Japan signals patience or delay, and risk assets breathe a sigh of relief and rally, because cheap yen funding remains available a little longer. This back and forth, tightening signal triggers fear, dovish signal triggers relief, has essentially become its own trading pattern that macro desks watch on a meeting-by-meeting basis. Every Bank of Japan policy decision now gets parsed by traders in New York, London, and Singapore with the same intensity as Federal Reserve meetings, something that would have seemed almost unthinkable just a few years ago when Japanese policy was considered a settled, predictable non-event. There's also a fiscal angle worth spelling out clearly, because it compounds everything else happening here. Japan already carries one of the highest government debt to economic output ratios of any developed nation on Earth, a legacy of decades of stimulus spending aimed at fighting deflation. A new government promising expanded spending and tax relief measures needs to fund those promises somehow. And in practice, that usually means issuing more government bonds. More bond supply, arriving at the same moment that some of the traditional biggest buyers, domestic insurers, and pension funds are already stretched thin by losses on their existing holdings, creates a supply and demand imbalance. that pushes yields higher independent of whatever the central bank is doing with short-term rates. Some strategists have gone so far as to describe Japan's bond market as having effectively become the real check on government spending plans, more powerful in practice than the political opposition. Because every time spending promises get discussed, long-term yields react instantly, forcing politicians to soften their rhetoric around the edges even while keeping the broader stimulus agenda in place. Bringing this back to the practical human scale question everyone watching this actually wants answered, will Japan really dump its treasuries and blow up the American bond market? The honest answer sits firmly in the middle, more nuanced than either the panic headlines or the dismissive all-clear takes suggest. Japan is not going to liquidate its treasury holdings overnight. The institutions involved are too large, too regulated, and too committed to gradual, liability-matched investing to behave like a hedge fund making a sudden directional bet. But Japan also isn't going to keep behaving exactly like it did for the past 2 decades, blindly recycling capital overseas, regardless of what yields look like at home. Because for the first time in a generation, staying home now actually pays. The most likely path forward is exactly the slow burn scenario multiple analysts have described. A gradual, multi-year redirection of maturing bonds and new investment flows back toward Japan, quietly reducing the pace of Japanese demand for foreign debt, even without any single dramatic headline event marking the moment it happened. And slow burns are, in some ways, more important to understand than sudden crashes, precisely because they're easy to ignore in the moment and only become obvious in hindsight once the cumulative effect has already reshaped the landscape. 5 years from now, when people look back and ask why U.S. borrowing costs structurally drifted higher through the back half of the 2020, so even as inflation cooled, part of the answer may trace directly back to this exact moment, to a $96 billion headline about Japanese life insurers that most people scrolled past without a second thought. That's usually how the biggest macro stories work. They rarely announce themselves with a single dramatic crash. They build quietly in the background through boring-sounding quarterly earnings reports and pension fund allocation memos until one day the world wakes up and realizes the entire financial map has shifted underneath it. Keep watching Japan's bond auctions. Keep watching what the Bank of Japan does at each policy meeting. Keep watching whether GPIF actually follows through on any formal reallocation, because every one of those seemingly small technical updates is another data point in what may turn out to be one of the defining structural shifts in global finance for the rest of this decade.